if these recipients of Chinese goods feel the heat and decide that they too should impose tariffs, we may still have the risk of a trade war moving from one place to another. So our message to everybody is be calm, and to China, be careful. Do not provoke other countries to see you as a threat to their economies.
The IMF is calling for calm and restraint as Beijing and Washington trade sharp barbs, escalating fears of a deepening trade war and global fallout from tariffs. Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. As the trade war between Washington and Beijing escalates, we'll speak with IMF Asia-Pacific Director Krishna Srinivasan about whether spillover risks can be contained. Growing concern about the U.S. credit market weighs on Wall Street as two regional leaders disclose loan fraud losses. We'll be joined by Morgan Stanley Investment Management's Andrew Slimmon to discuss the fallout. India's securities regulator says it's overhauling its algorithmic and high-frequency trading framework. Speaking exclusively to Bloomberg, SEBI's chairman, Tuhin Kanta, says the move aims to ensure a level playing field. Also ahead, the MD and CEO of one of India's leading insurers, HDFC Live, will be joining us for an exclusive interview after their second quarter earnings missed analyst estimates. Now, the latest on U.S.-China trade tensions. China's Commerce Minister Wang Wentao is blaming the U.S. for recent escalations, citing American actions after the Madrid talks. Wang says ties soured after the U.S. introduced a series of restrictive measures against China. This comes as IMF Managing Director Kristalina Georgieva calls for calm and restraint in the face of the growing tensions. Georgieva credits the world economy's resilience in the face of Trump's tariff shock this year, in part to nations not retaliating. But she also warns global leaders must not become complacent. Let's bring in Krishna Srinivasan, Asia and Pacific Department Director at the IMF. Krishna, good to have you with us. I mean, we have renewed U.S.-China trade tensions. How are you factoring all of that into your calculations when it comes to projections for growth, especially for China?
Good to be with you, Haslinda. So the increase in export controls, the most recent tensions, be it on rare earth elements by China and chips and technology in the U.S., and recent talk of potential additional tariffs, U.S. tariffs in China, illustrate the kind of risks to the economic outlook posed by trade policy uncertainty. As you know, Haslinda, we have forecast growth in Asia-Pacific to be 4.5% for this year, and coming down to 4.1% next year. But we also note that our baseline forecasts are subject to significant downside risks. And the kind of tensions we have been seeing recently are the kind of risks which we talked about in our report, which we say, and in our report, we actually do a downside scenario, which analyzing the potential impact of tariff increases and disruption in supply chains. Of course, the most recent announcement, the most recent cause of trade tensions are not the ones which we had modeled in our report, but what we show is that those are the kind of risks which could materialize. And in our report, in the World Economic Outlook, we show that for next year, in the baseline, we have growth at 3.1% for the global economy. But if these risks materialize, greater tariffs and disruption supply chain, then growth could be lower by 0.3 percentage points. Of course, the kind of tensions we see more recently are different to what we had in our report, but it speaks to the kind of risks that we see for the economy, for the world economy, including for China. Now, for China, we have 4.8% this year and 4.2% next year, and if there are further tensions, that could also mean downside risks for China.
This is a China that's also flooding the world with cheap goods. on the back of the tariffs being imposed by the U.S. How do you see this playing out? What is the cost to the world that China is doing this? How is that factoring into your calculations?
So there are two aspects to this, Haslinda. One is we should look at what's been happening to global supply chains for some time. Now, what we show is that global supply chains are being reconfigured since 2018-19 or 2017-18, when the first tensions between the US and China rose. So that reconfiguration is happening. And what we see is that China's exports to the US have been declining quite sharply since then, but China's exports to the rest of Asia, including notably to ASEAN, have been rising. At the same time, ASEAN's exports to China are rising. So there is this reconfiguration of supply chains, and this doesn't mean there's a rerouting of trade. It actually means there is actually reconfiguration because every country is adding value. Now, the question you're asking is whether there's excess capacity and that whole issue of how is that impacting the rest of the region. What we find is that in China, one of the big issues we have is deflationary pressures. Now, that's leading to lower export prices, which means that China is actually exporting a lot to countries around it, including the ASEAN, which are facing threat from Chinese goods. Now, there are two sides to this problem. One, of course, is a macroeconomic side, which is domestic demand in China is very, very weak. So when China addresses the domestic demand, including by boosting consumption, fixing the real estate sector, and so on, domestic demand should go up, and that will allow prices to go up. It'll help China reflate its economy, and that should automatically mean that less of a spillovers to the rest of the region. At the sectoral level, so that's at the macroeconomic level. At the sectoral level, what we see is China is providing a wide range of support for priority sectors, including EVs and so on. And that's led to policies like anti-involution and so on and so forth. And we've estimated the kind of support China is providing, the industrial policy support, is about 4% every year. So what we are calling for is for China to scale back those policies and remove trade and investment restrictions, which will both raise productivity and growth and also reduce internal and external imbalances around it. So internal balances within China and external balances
Krishna,
because of what's happening. Yeah.
We have spoken to policymakers around the region. They are concerned about China dumping their goods in Asian economies. I'm just wondering, what's the option out there for Asian economies? How do they counter the spillover effects from China's actions?
So again, Haslinda, one thing which we are talking about you'll see our forthcoming report, we talk about the fact that Asian economies can integrate more within the region. Right? And what we find is Asian economies now rely a lot on demand from EU and US for their exports. If they integrate more, reach greater regional integration, that will provide for greater support for Asian economies. In fact, Asian GDP could go up by as much as 1.4% over the medium term. And for ASEAN economies, the impact will be even higher at 4% of a real GDP increase over 3 years. In addition, Haslinda, to that, we are saying that Asian economies also need to pivot towards greater domestic demand. We are not seeing much of that since the pandemic. So Asian economies can do two things. One, they can pivot more towards domestic demand, not just China, but many other countries, and also integrate more within the region, which will provide a buffer.
Krishna, one of the fastest growing major economies, is actually India. But in India's case, its exports engine isn't quite firing. Is India's growth sustainable if it continues to be so?
So again, I think, Haslinda, for India at this point in time, we have growth this year at 6.6%, 6.2% next year. And that 6.2% reflects higher tariffs, the ones you mentioned now. Now, India aspires to be an advanced economy by 2047, what they call as Viksit Bharat. For India to get to that level, it needs to reach 8% growth at a minimum. And for that, India needs to fire on all engines. It needs to revive its domestic demand. It needs to revive external demand. And there, even before these, the tariffs you're talking about now, we've been talking about the fact that India needs to scale up. To scale up, India needs to liberalize its trade. India needs to, fix its labor laws. India needs to fix its infrastructure, where they've made a lot of progress. So India needs to fire all cylinders to get to 8%, But if they don't do that, then you have a medium-term growth of 6.5%.
You had a conversation with the RBI governor. What was the key takeaway for you?
So the key takeaway for me, of course, one, he said that there was significant coordination between the central bank and the fiscal authorities, which has helped them contain inflation. Now inflation is below target. So that's one key takeaway. And the other thing which he did talk about is the impetus there for greater reforms to get private sector investment going. Because one thing which you see, Haslinda, in India is despite growth being at 6.6%, private investment continues to grow at a pace which is not sufficient. So to unleash the full potential of the private sector, you need significant structural reforms, some of which I just talked about. And there was agreement that that needs to be done to get India growing much faster.
Krishna, I want to take a look at global growth as a whole. We know the IMF has pointed to the rising debt. It is expecting debt in the world to rise 100% by the end of the century. Give us a sense of what the biggest concerns are there in terms of the impact on perhaps financial stability.
So again, I'm going to focus more on Asia, Haslinda. So, Asia so far has grown pretty fast at 4.5% this year. And that's partly because of three reasons. One, because exports have been very strong. Financial conditions have been very supportive, low interest rates, low yields, and so on and so forth. However, we also warn that financial conditions could change. And given, public debt levels in the region are also pretty high, there are risks that if interest rates start rising, you will see a lot more debt-related vulnerabilities which will come to the fore. Even now, debt servicing as a share of revenue is very high in some countries. So if interest rates start rising, that will be a significant impact. So that'll have a significant impact. So that's why it's important for countries. I mean, what you've seen in Asia, Haslinda, is that one, the amount of fiscal consolidation since the pandemic is not sufficient. And if in that context, debt levels have risen. So if interest rates start rising, the impact on Asia could be quite significant. That's something which we underline as a key downside risk for Asia.
Krishna, what may be the implications on their currencies? Right now, we're talking about in the market debasement trade, which is a pullback from the USD as a result of what are happening in the world, what is happening in the US. What's your take on that? Are we seeing debasement, and how does the outlook for Asian currencies look like from here?
So when you talk about debasement, I guess you're talking about the dollar there. So, the dollar plays a key role as the world's reserve currency, underpinned by deep and liquid financial markets and sound and stable institutions, which have been very important. And so the dollar has played a very key role in trade, finance, and as a safe haven, right? So we do not foresee any changes on those functions. Now, if you look at the IMS, the International Monetary System, again, that is dollar dominant. But risks are there. So in other words, if in the context of geopolitical shifts, in the context of rising U.S. debt, trade tensions, and so on, this stability could be tested. But as of now, we don't see. We see the dollar playing a very key role, and there's nothing by way of competition right now for the dollar. So in that sense, I don't see a debasement of the dollar as something which we are worried about at this point in time.
What's the biggest risk for the Asia-Pac region in the next 12 months?
Sorry, I didn't hear the question, Haslinda.
What's keeping you up at night in the next 12 months when it comes to the outlook for the Asia-Pac region?
So, despite the fact that Asia-Pacific is doing very well, I think we worry about how these trade tensions could they are not resolved as yet. Dust hasn't settled on these trade deals. There's not one country which has, maybe Japan's the only country which has signed a trade deal, but these trade deals have to be signed. So these tariff tensions, the trade tensions are still pretty much predominant. So that can have a significant impact on economic prospects in Asia. Financial conditions could change. That could have a significant impact on Asia. And finally, if China slows down, we expect China to slow over the medium term. If that happens, you could have a significant impact on the rest of Asia.
We had Gita Gopinath, your former colleague, talking about, an over-reliance on the U.S. stock market, talking about a possibility of a loss of $3 trillion in terms of wealth out there. What's your take on what she's saying about the risks?
So the risks are there. I mean, like I said, at this point in time, financial conditions have been very supportive, right? Both in the world and in the region in particular. If you look at, for example, for the region, if you look at what's happening, interest rates are low, the dollar is weak. If you look at sovereign yields, they are low, and corporate yields are also low. So these are very, very accommodative conditions, right? The question is, what happens if trade tensions mount again? What happens if there's fragmentation in the world economy? These are risks which could turn things quite quickly. So that is why, we worry about the fact that if any of these things change, if financial conditions change, that could affect the economy, the regional economy, quite significantly.
Krishna, thank you so much for joining us. Krishna Srinivasan, Asia and Pacific Department Director at the IMF. Now, still ahead this hour, the equity rally faces mounting risks from the trade war and an AI bubble to growing strains in the credit market. We'll ask Andrew Slimmon of Morgan Stanley Investment Management what's keeping him up at night. Keep it here with us. This is Bloomberg.
You should assume that whenever something happens, we scour all process, all procedures, all underwriting, all everything. And, we think we're okay in other stuff. But my antenna goes up when things like that happen. And I probably shouldn't say this, but when you see one cockroach, there are probably more. And so everyone should be forewarned on this one.
JPMorgan CEO Jamie Dimon issuing a warning earlier this week that more credit problems were likely to emerge following the dramatic collapse of subprime auto lender Tricolor Holdings. Now, IMF Chief Kristalina Georgieva too urged countries to pay more attention to private credit, saying the risks building up in the private credit market is what keeps her up at night. While Dimon's warning reverberating across markets today as bad loans at two U.S. regional banks further fuel credit concerns. Banking stocks in Asia also under pressure, dragging down the MSCI Asia PAC Index. Well, let's get perspective. Andrew Slimmon, Senior Portfolio Manager at Morgan Stanley Investment Management, joins us now. Andrew, it's not just one cockroach, there are two cockroaches now. How are you reading that warning from Jamie Dimon?
Well, I think you have to consider that a lot of money has poured into private credit alternatives over the last few years. And the question is, what is the leverage on top of that? I think it's contained for the big banks, but the publicly traded alternative managers, their stocks have been screaming problems really for the last few months. While big banks and brokers have been going up, those stocks have been going down. So, I don't think this is going to be a 2008 scenario, but he's probably right. There's more to come. Now, one offset that I think doesn't get a lot of focus right now is that in early 2026, the Trump tax reform bill is going to give the consumer a big, shot in the arm in terms of tax relief. And I do think that will help some of the consumer areas. So maybe there's a gap here, but I don't think this is going to become a 08 type event.
But Andrew, this shouldn't happen in the first place, correct? You take a look at the economy, it's pretty resilient. You take a look at the rates, it's pretty low. This should not have happened.
100%, except for the fact so much money has poured into private credit. And what does that mean? That means that private credit managers will chase returns. And that's clearly, if you look into this situation, there was a high percentage of one fund was invested in one risk, one credit, and that just is symptomatic of too much money chasing into a product. And I think that's kind of the story here.
Okay, so it's not 2023, you say, but we saw that massive sell-off overnight. I mean, investors on edge, brutal sell-off overnight in regional bank stocks. I think they give up a huge amount, $100 billion in value. Do you see contagion? I mean, how are you reading into this massive sell-off if you say that's not really that much to worry about?
Well, I don't mean that. I don't want to sell it short. I think there are concerns, especially, I mean, the stocks of the publicly traded alternative manager are telling you there is risk out there. I just don't think it's risk for the whole system. And, you know, I could paint the positive picture that there were two good stories of today. Number one is, you know, the Fed is very sensitized to credit issues, so this will induce them to cut rates, probably more likely than it was before it propped up. That's good for equities. Number two is, look what got clocked today and hit hard, in addition to the banks, were all the super speculative stocks that have done very, very well, which usually rally at the late stages of a bull market. So I'm delighted to see some of that bubble, not in AI stocks, but in, you know, quantum computing, nuclear stock, flying cars, all the stuff, the money losing, you know, speculative tech stocks. Those are the ones got hit today, and that's good news.
You expect the bull market to roll on. Some like Geeta Gopinath, formerly from the IMF, are saying that, you know what, the world is too dependent on the U.S. She talks about, you know, an eradication of $3 trillion in wealth. Take a listen to what she had to say.
This time, the effects of any correction in the markets would be more severe. Many more countries would be impacted. Consumption would be more harder hit. So we are not exactly at very high levels of growth at this moment. So any of these shocks could generate a big turn in markets and in the economy.
Andrew, what do you make of the risks she's pointing out to?
Well, I mean, what she's pointing out, which is legitimate, is a big part of the GDP growth right now is coming from the AI build out. And if you strip that out, the U.S. economy is growing much more slowly. So I think there is some, you know, validation there. But I'm a portfolio manager and she's not. And what I say is fiscal policy, right? We're getting tax cuts, monetary policy. Fed is cutting rates. What's number one, first page of the investment handbook? Don't fight the Fed. The Fed's cutting rates. So you have monetary and fiscal policy that are stimulating the economy. And what's the third leg of that is sentiment is not very high. And so it's a
You're
powerful
a portfolio manager, Andrew. You're also riding the momentum, aren't you? And momentum masks risks.
That's true, but I am warning you that there has been too much speculation in some of the, you know, the real high beta tech stocks, and that's not the AI stocks. It's these money losers, and that screams of 2021. So to the extent that we can reduce that fever in those stocks, like today, because of an private credit issue, I think that's healthy. But I do not believe.
Andrew. Hang tight. We'll continue that conversation. Andrew Slimmon, Senior Portfolio Manager at Morgan Stanley Investment Management, is staying with us. Keep it here with us. This is Bloomberg.
It's been the most persistent, robust trend. And it's very hard to ignore.
But if you're thinking about the debasement, I don't see what the logic or the rationale for that is.
It's really primarily an anti-fiat currency movement.
I wouldn't be arguing for a rebound in the dollar. I think the devaluation, the weakening that you've seen over the course of this year is absolutely justified, but that doesn't mean that you see a further significant depreciation from this point forward.
So at least from our perspective, we do expect about a 4 to 6% further depreciation into 2026, and that's really underscored by the whole fading US exceptionalism story as well. Potentially, if things really fall off the cliff, we could even see a further depreciation, but not to the tune that we saw year to date.
That was insights from our guests this week on the growing debasement trade debate in markets. Andrew Slimmon, Senior Portfolio Manager at Morgan Stanley Investment Management, is still with us. Andrew, is your portfolio reflecting debasement trade?
Well, I don't own gold. Maybe I should. I run an equity portfolio. But I think what gold is telling you, I think people are very focused on the dollar. And I would point out to people that the dollar really hasn't declined since June relative to other currencies. So all the decline came early in the year, even though it's becoming more apparent the Fed's going to cut. I think what gold's really telling you is that the alternatives, as the central banks are cutting rates, is becoming less attractive, right? And so you're more willing to put your money into an asset that has no return on it if the alternative of returns is less, and fixed income has come down. And this is one of the reasons why, actually, incredibly enough, the history of bull markets is if you make it to the fourth year, which we are now in, stocks go up. And the reason for that is that early in a bull market, usually bear markets are caused by Fed tightening rates, and rates are higher. And people are traumatized by the bear market, so they rush into treasuries, which is exactly what happened in 2023, 2024. The number one pushback, as I said, please, the market's down 25%, get more optimistic. People said, well, I can get 1 to 2 year treasuries at 5%. Why would I buy bonds, stocks? And I said, because the market's just had a bear market. Well, that's rolling off, and investors are saying, oh, wait, I can't get that anymore. What should I do with my money? And some of it's coming into equities, but I think that's a big reason why it's going also into things like gold.
Andrew, what caught my attention from what you have just said was the fact that you're not in gold. You missed out on that massive rally. How are you looking at that?
Well,
I mean, some say it could get to 5,000 now.
I guess I could have owned the gold miners. But, let's not lose sight of the fact that they don't compound consistently over time, because gold prices is a commodity, and commodities do have, price fluctuations. It's, I remember in 2022 when energy went through the roof, and people said, wow, you don't own a lot of energy. And I said, well, it's a commodity, I guess I'm looking for more consistent compounders than commodities.
I just want to put it out there. Gold is up 66% year to date, Andrew. You missed out on that. Never mind what your thinking is. I just want to go back to what you said earlier about the AI trade. Of course, there's been a lot of debate of whether or not, it is a bubble. You still like tech stocks, but not necessarily the AI trade. Is that correct?
No, I like the AI trade. I'm just worried about the more speculative parts, the money losers. But I think it's early in the AI trade. I do not believe this is 1999, 2000. And the reason I don't believe that is because the demand at this juncture is insatiable. And that's different than the late stage of the internet, where we were laying a lot of fiber, dark fiber, with the expectation that it was going to be lit, and companies took out a lot of debt, and it never was lit. Now you have the hyperscales using their cash flow to invest in AI. It's a very different metric. The other reason, Haslinda, is, look, at the end of the day, AI is a cost savings for companies. AI has no healthcare costs. So companies are going to use AI as a cost-cutting measure. And yes, we know all about, how these chip companies and so hyperscalers are embracing it. But we haven't gotten the discussion of how profitability for corporations is going to go up, because they're going to be able to cut costs. And that's the second leg of the AI move, just like the internet. And that's still to come.
You talked about how AI is meant to help companies become more productive. We had an MIT report suggesting that 90% of companies have not benefited from the investment in AI at all. So how do you play this space? I mean, if you're taking a look at the future, I don't know, 24, 36 months, how should you be deploying your capital in the AI space?
That MIT study just tells you it's early. I was at the airport the other day, and I heard an airline say, okay, everyone that's in group 4, you're not going to get your bags on the plane. And I researched it and found out they're using a new AI tool that can tell them exactly when people that are bringing their bags on plane. So I think it will be employed because, airlines, you go down that plane and then your bag doesn't fit. You got to go take it off. I think companies will embrace it. And that MIT study just tells me it's early. Will there be excesses? Of course there will be excesses. But I think it's way too early, way too premature, and I take comfort in the fact that the demand still remains very, very high. I see it at our company. We're constantly trying to employ new AI tools, and I think that just tells me we're early in the cycle. Haslinda, I like to say, there's not a bubble in AI. There's a bubble in bubble talk of AI.
If we believe what you're saying, Andrew, what would you be buying? What's attractive in the AI space?
I think you want to stick with the big guys that are generating a lot of cash flow. One of the things I think is very dangerous is everyone's trying to find a way to get involved where they don't, people say, well, what about utilities or industrials? And I say, well, that's all fine, but make sure you research the day that DeepSeek hit, okay? Go back to when DeepSeek hit, because when bad news comes along like we had, and it turns out it wasn't as bad as people thought, it didn't matter whether it was the chips, the manufacturers, the utilities that are data centers, they all went down about the same. And so my biggest worry is people are buying more and more of these perceived non-correlated areas that actually are. So when you get some bad news along the way, oh, wait, your utility goes down just as much as your chip stock because, they're really another AI play. So, to me, that's the danger here is the correlation of different sectors. And so I think what's important is to have some AI exposure, but make sure you offset that with other things that don't have the exposure. You saw some of the banks, as much as the private credit is an issue, you saw some of the banks and brokers report very good numbers because their capital requirements are coming down. That's a good offset.
I know that you like China. Are you getting AI exposure in China?
I think so. I think you have to be careful there, right? Because, changes in policy can come very quickly. But I think there was a very important event in last February, which is when the Chinese government embraced their technology companies, and when that was a change in policy of 5 years ago. And I think that's recognition that they need these big companies. So I think it makes sense to have exposure there. And they don't move with the AI stocks in the U.S. And so it's less correlated than one would think.
So never mind the tech war between the U.S. and China, you're also liking Japan. Why? How much of it has to do with the governance reform we're seeing in the country?
100%. You're absolutely right. I think it's all to do with reforms, the desire to reduce cross ownership. For the first time, it is focused on profitability and stock buybacks. So I think it's a very unique situation, and I think again that's a good balance to kind of a pro-tech portfolio.
Andrew, before we let you go, what's the one asset you must hold through 2026? I know it's not gold for you. What would it be?
Well, I'm an equity manager, and I will tell you this, Haslinda. Look, we've had good performance because we've been overweight growth and value and underweight defensives. And that's been the right play. But as we recognize that we're moving to the euphoric stage and we're seeing these speculative stocks catching the kind of the zeitgeist of investors, that scares me. It reminds me a little bit of 2021. I think it's too premature. And so when we get pullbacks like we saw today or last Friday, I think that's healthy for the market. But the more their fever of these stocks, expands, the more I'm going to have to move a little bit more defensive, which means owning a few more consumer staples, a few more utilities that aren't AI plays,
right,
REITs and things like that, healthcare. I think it's early, but that's what worries me.
Looking forward to our next discussion. Andrew, thank you so much for joining us. Andrew Slimmon, Senior Portfolio Manager at Morgan Stanley Investment Management. Coming up, India's HDFC Life posts steady growth even as new GST rules squeeze margins. We'll have its CEO break down earnings, explain how the tax overhaul is reshaping life insurance demand. This is Bloomberg. Welcome back to Insight. India's securities regulator is overhauling its algorithmic and high-frequency trading framework. Speaking exclusively to Bloomberg, SEBI Chairman Tuhin Kantapandi said the move aims to ensure a level playing field for all market participants. The high-frequency trading segment is under scrutiny after SEBI accused Jane Street Group of manipulating stock and derivatives markets, a claim the U.S. trading giant denies.
Let us accept that the courts are fair. They give the people a chance, as much as to regulators as to others. And let that jury be out, let the verdict come. All what we have found is also very much in the orders themselves. And anybody can see, what is the kind of patterns it is there. We consider it manipulation. Somebody could say that it could be arbitrage. But there is I think as intelligent beings, we can really understand the difference between arbitrage and manipulation. Arbitrage is, of course, the arbitrage is the function of the markets. In fact, the markets function on bridging their arbitrage. If you have two exchanges, then obviously, the price will equalize across exchanges, because if there is one thing, the movement will take place. Now, future market is also, in fact, has to be supportive of the cash markets and vice versa. But manipulation is something which will have certain patterns, which will then be called manipulative. And the regulators' findings initially was in the interim basis that these are the manipulative pattern. But then people have been given a chance to rebut it. So it's not that, that's a final thing from regulator side also. So anybody who is wherever the regulatory orders are passed, they have every chance to go back when they are asked for a show cause or for a reply, or they can go to a higher forum. So let that be. I think we should not be discussing individual cases, but I'm talking as a generic thing for any such case of this nature.
Chairman, one thing is clear. A lot of firms want to be in India right now. We're seeing a lot of interest. How do you see the HFTs especially and algorithms? AI is here to stay, of course. How do you see machines and technology playing out in India? What kind of role do you see for them in the Indian capital markets?
They are already doing a substantial part of the trading which takes place is through algo trading and HFT trading. We have already a regulatory framework in place in terms of which algos will be allowed, how they will go to the exchanges, they will be tested in simulation, and also that they do not pose any threat to the markets. But since the technology is also evolving very fast, we should also keep ourselves updated.
And that was SEBI Chairman Tuhin Kantapandi speaking with Bloomberg's Jeanette Rodriguez at the Bloomberg Forum for Investment Management in Mumbai. Now, we're also following India's earnings season. India's second largest private insurer, HDFC Life, posted quarterly net income that missed analyst estimates. The government's changes to GST rules were a major factor squeezing margins and impacting profitability. Vibha Padalkar, Managing Director and CEO at HDFC Life, joins us exclusively now. Vibha, good to have you with us. Do you expect the GST rule to continue to weigh on earnings going forward?
Hi, thanks for having me on your show. In the short run, there will be an impact, as we have called out. For the second quarter of our financial year, it had a 50 basis points impact on our margins. And that was just for 1 month. However, what we feel reasonably confident is that over the next 2 quarters, we will try. There are 4 or 5 things that we have panning out, which should neutralize this impact by the time we exit the financial year in March 2026. And thereafter, the following year, starting 1st of April 2026, we will be back on track. And hopefully demand also comes through. So it's not just the negative news, but hopefully demand from customers as a result of this tax cut also starts coming through and would be accretive to margins.
You talked about 4 to 5 moves that could counter the impact from the GST cut. What are these, and what kind of numbers are you looking at in terms of the counter effect?
Yeah, so like I mentioned, so this 50 basis points means it translates to about 300 basis points if we did not do anything, and also if we do not take into account increased volumes. Some of the things that we have that we are working on, one is that our own costs, to see how we can rationalize them, because everything that we spend other than employee costs and depreciation more or less attracts GST, which is a cost now to us. So that's something that we are looking at actively, of renegotiations with our vendors. We're also looking actively at sharing some of this with our distribution partners, and those conversations are either completed or are in progress. That's point number 2. Point number 3 is that how can we further optimize our product mix so that slightly more higher margin, longer term products could make up for this shortfall. And unit linked as a category is disproportionately impacted due to GST. So how do we lower that? That's point number 3. Point number 4 is aspects such as riders. How can we double down? We do quite a bit of them, but how can we do that across product categories? That's point number 4. So these are some of the things that are already in progress.
Do you see downside risks from the tariffs tension? I know negotiations are ongoing right now. Do you see that impacting your margins going forward?
Not directly. We are largely a domestic-led insurer, and domestic demand is fairly robust. However, domestic demand has been impacted this year a little bit, similar to what banks are seeing or lending institutions are seeing, a generic slowdown in overall capacity to consume anything, and insurance is included. So it's more domestic aspect rather than a direct impact of tariffs.
How are you looking at growth? Some are suggesting that perhaps your management expense growth exceeds that of your premium growth going forward. How are you looking at controlling and reining in costs?
The way we look at this is right now, we are in the investment phase. It's very easy for us to just stop investing. And investing, by that I mean in 2 significant buckets. One is in technology, and this is bringing the entire tech stack, including cloud as well as AI ML, to make it ready for the next at least 4 or 5 years. That's number one. We are halfway through that. And second is on our building and strengthening our proprietary channel. We have opened close to 200 branches across India, especially in Tier 2 and 3 cities over the past 18 to 24 months. And we are towards the end of that phase as well. We are now also having people and so on. But that's already, the new branches of agency are already showing a contribution to agency overall numbers of about 11%. So beginning to see results on these investments. So that's really why our costs look a little bit more elevated. But if I were to back out these investments, it's showing a downward trend.
When it comes to insurance, of course, it is about the penetration rate. How are you seeing opportunities in the next 3 to 5 years?
I'm extremely bullish because a few factors. One is overall penetration rate, like you said, is low. However, awareness is now increasing thanks to both the government, something like the GST does create a phenomenal amount of awareness to get people to focus, and also for the government's message that this is important. Another part is the demographics, wherein people are slowly getting either into the earnings level, so 25 and above, and also people are getting increasingly older. By 2030, about 15% of our population will be close to above 60 or 65 years of age. So it augurs very well for life protection pension. So inherent demand is there. Second is in terms of per capita GDP. As that rises, the need to protect one's savings, and that's very clearly apparent in some of our states that are close to $4,000 as against about an average of $2,300. So we're beginning to see that. So that correlation is clearly coming out. Third is socioeconomic changes. Earlier joint family, real estate, gold used to be a proxy for insurance. That's changing and has already changed, certainly in Tier 1 cities, but also in Tier 2. So all of this augurs extremely well for the future growth of insurance in India.
Vibha, there's also rising climate risks, and we're definitely seeing that in the extreme weather patterns in India. How are you looking at the potential? How are you integrating that into your products?
So this is more an area for general insurers. So in India, you have life insurers and general insurers, or PNC, as it's more popularly known. But however, a second order impact certainly can't be ruled out on sections of population that are impacted by flash floods or any of the other aspects. And that's something that we do cover via catastrophic risks. Fortunately, so far, it has been fairly contained, but we watch this space very closely. COVID was another space that we were disproportionately impacted. But second order impact will certainly be there.
Vibha, thank you so much for joining us. Vibha, we have to leave it there, Vibha. Thank you so much for your time. Vibha Padalkar, MD and CEO at HDFC Life. Now be sure to catch our interview with Canadian Prime Minister Mark Carney talking trade and what he's learned from dealing with President Trump. He'll be on the debut episode of the Michelle Hussein Show. Keep it here with us. This is Bloomberg.